There's a lot more, activity, a lot of interest. Volume is up a little bit, and cap rates are actually diminishing for the first time in a while. And so they're compressing a bit, 20, 30 basis points, but that's a start. So my feeling is that it could be an inflection point.
Hi, Adam Gower here, founder of gowercrowd.com and host of this podcast YouTube series, Real Estate Market Watch, current events through a real estate lens. My guest today is David Lynn, who is currently Chief Executive Officer at Unity Investment Management, a private equity real estate shop specializing in medical outpatient buildings. You're going to learn a bit more about that, MOB. David has a storied history and record. He's published books, looking at one here, published 5 real estate investment books, including Active Private Equity Real Estate Strategy by Riley Publications, Real Estate Mathematics, PERE, or Private Equity Real Estate Publications. He has a PhD from the London School of Economics, my alma mater, my undergraduate alma mater, and an MBA from MIT. He is a prolific paper writer, actually, on LinkedIn, that he shares on LinkedIn. There's really fascinating, in-depth studies of what's going on in the economy and how to navigate what's going on. So you're going to be hearing a lot about some of those deeper insights that you won't get anywhere else here on today's conversation with David. If you have not yet done so, please actually go ahead and connect with me on LinkedIn. I usually talk about subscribing to my newsletter, but go ahead and do that at gowercrowd.com. But also connect with me on LinkedIn. You'll find me there, Adam Gower, of course, or Gower Crowd should pop up fairly easily. I do write a lot there, and it is a lot of fun engaging in conversations about interesting, important matters with some very, very bright people out there. So please join the conversation there with me on LinkedIn. All right, so let's get going. David James Lynn, PhD, Chief Executive Officer currently of Unity Investment Management, coming right up. David, what a pleasure to see you again. Thanks so much for joining me on the show today. Before we get started, well, you are a prolific an in-depth writer, and it's a real pleasure to follow you on LinkedIn. But before we get started, just tell us tell the audience a little bit about Unity Investment Management. What asset class do you focus on? And also just please share, without being in the slightest bit humble or modest, scale of the company.
Well, Adam, thank you very much for having me today. It's really a pleasure to speak with you. I've followed you for many years, and so finally I get a chance to be on your show. So thank you. Unity Investment Management has a focus on medical real estate, particularly medical outpatient buildings, which have really become, in a way, replaced large hospitals for most Americans, where they receive the majority of their health care. So these are the buildings usually within a medical corridor that are adjacent to hospitals, and so we focus on buying, managing, and improving those buildings. So we have a portfolio of just shy of $1 billion in assets under management nationwide, about 30 states, about I think 74 buildings and 550 tenants. So they're mainly medical, clinical, and within that we have a number of surgery centers and a few other types of uses within the medical MOB categories. So that's kind of what we do, and we're fortunate to be in the sector. We like the dynamics, and we can talk about that or anything else you'd like to.
All right. Well, so I would like to talk about the dynamics. I've got a bunch of questions for you, but I am a huge fan of medical office, actually, and anything at all to do with the aging of America strikes me as being an asset class that has extraordinary tailwinds. But I am not the Chief Executive Officer of Unity Investment Management. Why do you like medical office buildings?
Well, I mean, I think it goes back many decades for me, where I invested in a variety of assets. The main food groups, as it were, the Ford food, as we said before, real estate main groups, you know, multifamily, industrial, retail, and office. And then I've also over the years invested in alternatives, including medical. And I always felt that medical was one of those steady eddies, underpinned by very good demographics that seem to improve over the years, an aging population, more medical care, more medical technology. And it has a very low beta, so very low volatility through many different cycles. And I remember distinctly through the global financial crisis, I was part of a large group, partner managing director, also a member of the investment committee, and that was the best performing sector. You know, very, very low default rate, the
Mm,
lowest default rate. The tenants stayed in, they paid. You know, it's the other thing I like about medical is that it's non-discretionary, right? You really have to have it, and I think it's a little bit less price sensitive. So medical providers really can, set the prices more or less. You don't really do competitive shopping. And as we age, as we have developed our knowledge, our medical, acumen and knowledge of illnesses, how to treat them, the technology being a part of that, AI now is a part of that. I think there'll be a greater need to go to the doctor, to visit our buildings, to see our specialists, because there'll be more things identified for your health, and there'll be more ways to treat them. And then a couple of things that we see in the horizon that are actually becoming more popular now are personalized medicine. So how can we focus our regimen, our treatments, our drugs to you as a person, individual, your individual makeup, as well as longevity. So I think we are an aging population, a more affluent population, and we just see those two things driving medical demand, as well as the overall demographic picture that you alluded to earlier.
mm,
You know, the baby boomers are a very large cohort, and they're all elderly at this point. And so when we get older, we need more medical care. And
mm,
so, but also the younger population, younger cohorts in the population are, they prefer, if they have a choice, they'd rather go to a medical outpatient building rather than a big, older hospital. So those are some of the trends that we're seeing.
mm,
But we don't think that medical care will lessen. And I think people have talked about, telehealth maybe taking away some of the demand from the physical space, the physical tenants. We don't see it that way. We really see telehealth, telemedicine, actually driving demand. That was my original thesis before it became popular during the COVID period, and
mm.
it's been borne out to be true. So typically, you have more an easier conversation, easier perhaps an easier relationship with your medical providers because you don't have to go in. You can have a quick telecall, but then almost invariably you'll be told you must come in to be examined for treatment, right? We can't do this online. So a lot of there are a lot of people out there, and I include myself in this category. I really try to avoid the doctors. I'm very shy about
Mm.
even talking to a doctor, but going to a doctor, having that visit, um, it's not something I like to do, but if I can do a telemedicine, a quick call, then I have some information, which is actually good for me for my health status to have that kind of information from a medical professional in wherever I am on the go or at home. But then again, I'm aware that my medical professional makes me aware of the situation, my health situation, and nobody's perfect. So it'll be, gee whiz, it sounds like you need to have a blood test. You need to have your yearly physical. You need to have, whatever examined. Your heart murmur doesn't sound good. You need to come in. So it does, I think, drive more business to, overall resulting in greater medical demand.
It's fascinating, actually. What an interesting perspective, David. I've never thought of it that way. Actually, the ease with which we can see our primary physicians. I mean, most of like men are, I don't know, I speak horribly stereotypically, but generally men, like I also, can't be bothered to go. I'm feeling fine, but I don't really need to go. But if it makes it easier to use telehealth, to do a video call or whatever, the chances are that you're going to be encouraged at some point, and I hate to use this marketing term, but upsold to more advanced treatment. that it can actually drive in-person medical care as well, can't it?
You hit the nail right on the head. I think doctors would probably not like to be referred to as upsellers, but that in effect is what happens in many cases because the doctors really they realize that they have to make a living too, and so the 10-minute visit does not really pay the bills. But more importantly, I think most medical professionals are very responsible. And they'll see things in your health in your record, you know, that again nobody's perfect. They would like you to come in. Maybe it's just a spot on your forehead after an afternoon of sun. Well, she was that could be cancerous. Let's take a look at it. We can't do that online. We can't do most things online. You've been having these headaches over the last few years. Well, I think you need to have an MRI, you know, and the doctor discovers that only through this conversation where you're right. I think a lot of people, maybe more men than women, tend to avoid having those conversations, tend to avoid going in to see the doctor. So this makes it a little bit less friction, less painful. And so I think it's a win-win for our society and for medical demand, quite frankly. And then, you know, our formats, the medical outpatient building, I think is a little bit less
Mm.
daunting, a little bit more inviting, right? You know, it tends not to be emergency care in there. They tend to be more private pay or kind of just a better user experience, if you will. So, you know, those are the things I think those trends will continue in the future, strengthen in the future, aided by technology. So again, more and more things are being discovered, more diagnoses through medical technology.
Mm.
Genomics is uncovering a lot of things that need to be addressed and that you can address now. And so that will be even more demand. So, and you couple that with AI, you know, with the technology, with genomics, and I just see a lot more diagnoses, a lot more treatments, a lot more pharma, and you've got to come in person for that. And I think you know, most of us, you know, might feel comfortable ordering something from Amazon, you know, like a set of tires or something. But when it comes to your health, it's very personal. It's incredibly important, you and your family, and it's very private. And so I think you never want that relationship to be, you know, solely online. It can't be online. There's that privacy dimension too, and you really want to see a real live human, professional, a medical professional.
Mm. Yeah, it's actually I'm going to backtrack on the idea of upselling. I know there is a Hippocratic oath, and it really is in the patient's best interest. I did mean just the expansion of better healthcare is inevitable, actually through telehealth. But just drilling down on the medical office building sector and your focus particularly. Before we get on to some of these bigger macroeconomic questions, some of these incredible papers that you've been writing, are you so how does it work in medical office? Or how does it work at Unity Investment Management? Are you value add players or is it coupon clipping? I mean, like, what are the kind of high level, what are the economics that you look for?
Yeah, I mean, I think there have been some operators in the space, some investors who've been more of let's say, the coupon clippers, you know, very long leases. The tenants tend to be very stable, very credit worthy. They tend not to move very often. They tend to renew at a very high rate. But we felt, particularly with the onset of very high inflation, that it made more sense to pursue shorter leases. And
Mm,
you know, given the characteristics of the tenants, as I mentioned before, very conservative, they tend to stay. They usually do renew, and particularly if we do our job, we treat them right, we're great, responsible landlords, which I think we are over the years. We've proven that. And why not have a shorter lease where if we know that there's a great likelihood of them staying, their tenure, we look at that, how long they've been in the building rather than just the lease term, right? We look at how long they've actually been there. We call that the tenure. Um, they were willing to take that bet, and we've been taking that bet, particularly with inflation. So we've been able to achieve higher base rents and higher escalations
mm,
with a little bit shorter term. So instead of a 10-year plus, we look at 4 to kind of 8 years, and particularly on multi-tenant buildings where leases are staggered. So you really don't have as much risk. But in addition to lease up, we do you know, capital improvements, we do repositioning. So we tend to be in the light value add space, not heavy, but certainly not core or even core plus. And we find that investors find that very attractive
mm,
with higher returns, but with really, I think, not taking on any more risk. and while still delivering a pretty I think a very attractive current income, and which I think is even more important today. We hear a lot of criticism about private equity not returning money, and your money's locked up, and valuations have been
Mm.
dropping. But if you have regular cash flow distributions from your property, then you know as an investor it's actually performing.
Mm.
It's not a black box. It's doing exactly what they promised, and that's a key part of your return. And fortunately, we were very prudent when rates were extremely low and cap rates were extremely low, so we weren't big buyers then. And we were either fortunate or lucky, but we really began buying at the kind of the midpoint of 2023, which we think looks like to me perhaps that is a bottom if the Fed continues to cut rates, if inflation continues to decline.
Oh gosh, yes, perfect segue to my next question. You've written this fabulous paper talking about the banquet, low rate, ultra low rates created a banquet for real estate investors. What a lovely concept. All right, so what do you mean by that? I mean, describe it because you also do lean into the impacts of that on multifamily as well, which is most often the favored asset class or the asset class that is most favored by passive investors, but probably because it's so intuitively understandable. But talk about the banquet and what are the lessons that we've learned from that?
Yeah, that's a quote from Robert Louis Stevenson that all of us eventually sit down to a banquet of consequences for our actions over the course of our lives, and so I use that to talk about the very low interest rates that real estate investors have benefited over the gee whiz the past 15 or so years, actually more than 15 years,
Mm,
really since the onset of the global financial crisis. I mean, rates have been very, very low. They came up a bit, and then we had COVID. They went down again. So investors have been able to borrow at very low rates, and that means, of course, much greater demand, much greater competition, and so cap rates were driven down to very low levels. And I think a lot of investors really ignored history that rates are typically not that low. The average borrowing rates are 300 points at least higher. And so when you're buying at these very low cap rates, particularly multifamily, as you mentioned, very popular sector, for all the good reasons. I mean, great demand, necessity real estate. A lot of people need it. And the ability to raise rates with very short-term leases, right? So leases are not 10 years; they're usually 1 or 2 years, right? So you can really raise that base rent pretty quickly and dramatically. So all good things, but all good things often become a crowded trade, and so cap rates were driven way down. And then when rates came up, you've got a negative spread going, which is always a terrible thing. And a lot of the debt that was done in, 20, 21, 22, is going to be resetting pretty soon, the next, year to 3 years. And so the consequences will be pretty painful. And so I think that's what the article was trying to get at, that already on paper, there's some pretty significant losses. And when those loans reset, they will be realized. Um, it's just a matter of being prudent about pricing, long-term pricing, paying attention to cap rates and the potential volatility of the debt structure, the capital structure, particularly the cost of debt. So we think it'll be a higher interest rate environment going forward. Nothing like what we've seen over the last really I'd say almost 22 years, the last 22 years when you think about it. They won't. We think they'll probably ease down with inflation going down. The Fed has cut 25 basis points recently, and that's a very good sign. And inflation probably will ease down over the next year. We don't know how long that'll take. With the tariffs, there's some upward pressure on that. But in general, the big consumer items are inflation is flattening out or actually declining. So energy is actually declining. Food is flattening out, and these are actually, interestingly, these are not really included in the definition of core inflation, but they really should be. It's what households mainly consume. Housing, another big ticket item. The cost of housing is largely domestic. And most of the materials going into producing housing are domestic as well. So those are countervailing forces to
Mm.
inflation. Of course, the imports are probably going to be higher in price, but as a proportion of our total economy, our GDP is only about 11% based on imports. And then within that, um, some of those items are discretionary. Like clothing, for example, textiles. We don't need to buy, new clothing, every single day, every single week, right? They're a little bit discretionary. Or new cars. A lot of cars are imported. A lot of us have existing cars, right, that we can use for many, many years to come. And we have domestic cars. So domestic things obviously are not really inflating as much. But we think there will be a bit of inflation from imported goods. But when you look at the total structure of the economy, I think it's often overblown. It's not that much of an impact.
All right, so back to the banquet, and just kind of coming back ahead of these other concepts, and we'll get back to them in a second. You talked about the impacts of rapidly raising interest rates, essentially, right? That has caused some of these consequences that we've been banqueting on. Why is that? And particularly in multifamily, which has both high demand, low supply. It's a necessity, and in some ways, it's kind of similar in terms of its demand characteristics as medical office. So why has medical office building not had the same consequences of this sudden jump in interest rates? Why are you seeing that not having the same the same pipeline of maturities coming up as we're expecting with medical with multifamily?
That's a great question, Adam. But too much of a good thing can be too much of a good thing. So everyone likes multifamily. It's very accessible, very easy. It's very ubiquitous. It's a huge sector. It's much bigger than the medical sector, for example. It's more widely traded. It's more efficient. So I think a lot of investors piled in because of the obvious attractions, as we mentioned, demographics. It's a necessity, the ability to raise rents, that sort of thing. And I think it became just too popular, quite frankly. It was oversold.
Mm.
And I think not enough mind was paid to the cost of capital, that we are living in a very, very unusually low debt rate environment. And you put that debt on, and you buy a three cap, and the debt should be, you should have a positive spread. I mean, that's sort of basic real estate investment 101. In
Mm.
many cases, they had a very narrow spread or even a negative spread going in.
Mhm.
A lot of folks were buying it at three caps. The cost of debt was even in the good time, in the halcyonic low interest rate times, it was a little bit higher than that. So, but they thought NOI growth, rent growth will bail them out, and often it did. Landlords could raise rents, 3 to 6% per year for multifamily. In many cases, in many markets, that's not quite as true now. So it's pretty rare to have those kind of rent increases lately. So you can't bail yourself out through NOI growth. All right. And the cap rate compression won't be there because you're buying at a very low cap rate. And so you're kind of caught. But I think it was really I think people move in crowds, herd mentality of this is a great investment. And historically, people have done incredibly well. So if you bought at a very high cap rate, 10 years ago, cap rates for every sector have been compressing, but some sectors even more faster, to a much greater degree. But, 10, 15 years ago, you could buy a multifamily, particularly class at B and C for 6, 7, 8 caps. Those days are probably gone forever. But why the difference? Why not medical? Medical always had higher cap rates, and it's more of an alternative. It's not a main sector. So
Mm.
that's a big factor. Not as many people know it. It's more informationally inefficient, not as much information, not as many brokers selling it, and just not the same volume. Um, it's also a little bit more difficult to replace, right? Because it's a technical, specialized type of building. Whereas multifamily, there are plenty of multifamily developers, and it's fairly easy and quick to build multifamily. And then the other factor with MOBs, medical outpatient buildings, is that you really need to have it pre-leased to at least 50%. And lately, the last couple of years, that's been more like 70%. So multifamily, how much pre-leasing do you need? Zero, right? Build it and they will come. Remember the field of
Right.
dreams that everybody needs multifamily. So there's no pre-leasing requirement for multifamily, but there is for medical. So if you go to a lender, hey, I want to build this building. Well, gee whiz, so who are your tenants? Have they signed up? Well, not quite yet. Well, sorry, we can't give you that loan. You're not going to build this. And yeah, I think also it's just those are pretty important factors. So the supply has really not been there to really push down cap rates as quickly as profoundly as multifamily, but
Mm,
the demand has been yet very good, steady, and I think it hasn't been quite you, you know the crowd has not really run to certain sectors like they have to multifamily. I think the last say 5 years it's been multifamily and data centers and industrial have been very popular, because you hear about them on the news, e-commerce, AI, gee whiz. And so the popular retail investor has really piled into those sectors and in the form of funds and REITs. So that's also helped to drive those cap rates way down and not so
mm,
much for medical buildings. Again, medical buildings have been not incredibly exciting because they've been steady eddies with steady rent increases, steady demand, steady growth. So it's kind of not been the belle of the ball in terms of the popular attraction. So,
mm,
but that's been a good thing, obviously. So we don't have the incredible cap rate resets. We don't have a lot of upside down deals. We don't have a lot of distress, and the nature of the tenants as well. They're not feeling medical tenants by and large are not feeling distress. I mean, they've been able to pass on the increased costs, the increased inflation to their patients. I think we've all seen that in our medical care. It's a higher medical bill,
mm,
and again, most of our tenants are mission critical, and they just have had good balance sheets, and they've been to in our locations, our buildings for quite some time, and
mm.
so yeah, we just don't see a lot of distress, but we didn't see a huge run up. Again, I go back to it's a low beta sector. It just doesn't go up dramatically really quick, but it doesn't go down dramatically very quickly either.
David, you actually used a term that I've not, well, I've heard it, but is there a distinction then between medical outpatient buildings and medical office buildings when one talks about MOB? And are you focused exclusively on outpatient? And what is the difference?
Not really.
Okay.
It's a term of art that some of us have adopted in the last few years. That we're trying to highlight the distinction between our medical buildings, which are really mission critical
Mm,
medical buildings for medical practitioners performing medical treatments and surgeries, etc. Versus office buildings, which
okay.
are totally different. They're not for medical. You don't have medical technology there. They're not purpose built, etc. So offices really suffered a great deal. So some people paint the old term medical office buildings with the same brush as they do office buildings. So we try to, it's sort
Ah,
of more of a, it's a broker sales job, if you will, that we just try to say, look, they're outpatient buildings to distinguish them from hospitals, which often tend to be inpatient buildings. And I think it's actually a more accurate term. But we do want to highlight the distinction between what we do and the office sector.
and the other OB. And so do you just invest in ground? I'm sorry, do you invest in ground up or existing or a blend of the two?
Yeah, we mainly existing,
Mm,
to develop. We will do ground up, but usually with a developer. We'll partner with a local fee developer, but we'll manage the overall development process. So we have
mm,
that in our capability. And some of our investors want that. They want a new building. But we found that the returns usually are not as attractive overall. The fees can be higher because you're doing more management, more value add work. But the overall return is not really better than what we do. In fact, it's usually less than what we do. But you're really performing a lot of work. It's a lot of opportunity costs that you have to do. Well, medical buildings tend to be rather small. So it's different when you're developing a 300 unit multifamily building, for example, then your time is really worth it. But if it's only a 10 to 30,000 square foot building, and you're getting a decent return, a 14% return, levered return, but you've spent 4 or 5 years doing that, it's not really worth it, I think, for us and our investors.
So you've talked about, so we were talking about this shift from an era of easy money to today's higher rate, I suppose, higher risk environment. So what are the biggest challenges in your view? What are the biggest challenges shaping the economy and real estate markets today?
Well, I think there are many. I mean, it's a very confusing macro environment. I think a lot of people are just guessing in the dark. We came off a devastating global pandemic. Record high inflation we haven't seen since the '70s, late '70s, early '80s. Um, a new administration with many new policies. Um, there's certain things that are happening right now, like a curtailing of immigration, the tariffs that we've never really done before, we've never really seen before, right? That how will that affect the labor markets? How will that affect pricing of various imported goods that are important in our economy? And then the recent H-1B visa fee, $100,000. That's a big increase.
Does that impact the medical industry as well? I know it's certainly tech, but it's not doctors that are coming in on that, is it?
No, not really, not
Right.
really.
Do you have to be qualified here anyway, don't you? You can't be qualified there and then come here and practice.
That's exactly right. That's
Yeah.
exactly right. So, yeah, we don't see it having a big effect on our sector. It's mainly the technology sector, but I think
Mm.
um, with the advent of AI, I'm pretty confident that a lot of these tech jobs, the lower level tech jobs, are going to actually be obviated because a lot of it's sort of pretty rote coding, and and it's happening at sort of the perfect time. And you'll hear large technology companies like Google and Apple, and you name it. They said, well, it used to take 5 people to do this piece of code. Now it takes, a half of a person, mid-level
Right.
senior person, but all that's been automated with AI. And that's only in the last 2 years. So that's
Mm.
having a profound impact. And a lot of the H-1B visa applicants, in fact, were not highly skilled. They were sort of lower level, technology coder people. And so now I think they'll have to be much more selective. This has to be a person with very high skills, very rare skills. Therefore, it will justify the $100,000 fee. So we don't
Mm.
think it'll have a huge impact, quite frankly, on the economy. And I think the technology companies are shifting already. They have been shifting over the last 2 years.
What about immigration? Has there been any impacts? I know that in senior housing, uh, finding qualified staff is extremely difficult, very challenging. And particularly now with the new immigration policies of the current administration, is that also impacting medical outpatient buildings? Is there much of an impact on that at all in any way?
Not really. As you say, it has. I think it has a bit of an impact on senior housing, where you
Mm.
lower skilled, assistants and orderlies and things like that. A bit of an impact on agriculture, a bit of an impact on
Mm.
construction labor, domestic health. But not. We haven't seen that in the MOB space. They're licensed professionals. They're higher skilled. They're not really MOBs are not really overstaffed per se. I mean, typically they're run by a doctor, a partnership, or a medical corporation, and they're really careful about their expenses, about the cost of operations, because typically they're owned by doctors in a private partnership. So they're really careful about their money. It's not a huge corporation. Sometimes it is. But a lot of people go to an MOB, a lot of professionals go to the MOB to be more efficient, to be more
Mm.
profitable. And so they're inherently, I think, more efficient than a large traditional hospital.
Shifting back to the interest rate environment. So now cap rates have also been rising particularly since 2021. You've been writing about this. Do you think that the recent stabilization is a turning point? Are we at a turning point? In other words, have we hit bottom? I suppose is the core question there in terms of cap rates across commercial real estate.
The old $1 billion question.
Right. Have we hit bottom? How can we time the market, please, David? Please help us.
It's I my some people would hazard a very precise forecast. We have a 48 something percent chance of cap rates going. I'm not that type of person.
Mm,
Forecast never have been. I think it's important to think of scenarios and to get away from exact forecasts. But having
mm,
said that, I think we've gone through about a very high inflation. I think we're over that hump. I think it's been going down steadily. Um, I think a lot of consumers are quite exhausted actually from
mm,
and they're beleaguered, and so they're cutting back on their purchases. For example, going to restaurants, that's way down. Not so much fast food restaurants, but full service restaurants, for example. Certain discretionary items like clothing are, those are down. So I think you're seeing lower inflation because of the consumer, lower inflation because of the producers.
mm,
And so that's a very positive sign. And you see the job report. The economy is not doing that well. Those readjusted figures are pretty profound, actually. So they backed out something like 900,000 jobs. So the economy is pretty weak. I think when you have people, concerned about their employment, concerned about their income, they're going to spend less. They're going to be more risk averse in general and try to curtail their spending. So that's deflationary. So there's some big factors in our economy, like energy is opening up. So energy is going down. That's a huge horizontal in our economy. It's not just the cost of gasoline and heating your home. Petroleum goes into everything these days. I mean, it's a real horizontal. Transportation, plastics,
right.
many things. So that's been very beneficial. And we haven't seen it in the cost of food. That inflated quite a bit, but that's flattened out. It's going down. I think my feeling is that lower migration actually might lead to greater automation in the food industry. So when you go to some
Oh,
countries like Europe, if you go around at harvest time, you're wondering where all the workers are, and you see a bunch of machines because the cost of labor in some of those countries, like France and Switzerland, for example, is very high, and so they do a lot more automation. But and I think that will happen here, and that could lead to lower costs. And then the AI-ness of everything is really happening now. Processes,
mm,
logistics, coding, high tech. I mean, it's affecting everything. Transportation is becoming more efficient, for example. You name it, it's going to affect, it is affecting everything. That's deflationary because it's just, instead of having five workers to do something, you have one worker. And yeah, I
mm,
see that as a profound deflationary force. So my feeling is that the Fed recognized the weakness in the economy and the employment numbers, that we are trending lower in inflation. There's still some big question marks, as they point out, about tariffs,
mm,
but they made that rate cut. So that could be an inflection point. I think it might be actually, and I think there's a lot more activity, a lot of interest. Volume is up a little bit, and cap rates are actually diminishing for the first time in a while. And so they're compressing a bit, 20, 30 basis points, but that's a start. And there's a lot of pent-up capital that has been prudently on the sidelines, waiting for a time to come in. So my feeling is that it could be an
mm,
inflection point. It could be a time to come into the market,
mm,
particularly now when it's uncertain, right? The economy is still not very good, probably getting worse. But if you're a long-term investor, real estate investors tend to be, multi-year. I mean, at least 3+ years. It's actually a good time to come in when there's a bit of fear and doubt in the market. Yet debt rates are trending down, cap rates are compressing a bit,
mm.
and there's more liquidity, so sellers are putting more property in the market. So I'm going to make a guess that it could be a bottom of sorts, and not a bad time to come in.
All right.
Yeah.
So I'll tell you what. So you talked about the recording and this, that, the other. So if you are wildly wrong, we won't mention that again. But if you are precise and exact, we'll come back and we'll take that clip to prove that you are exactly on time. You were the one guy that got it exactly right at the exact right time. All right. So we'll do that. But you've also talked about, you've highlighted the this maturity war, right? $1 trillion in loans. A 25 basis point cut is not going to save the day. So, what do you think of the implications of, or how should investors be positioning themselves today? Do you think with this refinancing wave, especially uh, as perhaps, and I would tend to agree with you actually, that you are bouncing along the bottom and looking towards an upward trajectory, particularly with interest rates apparently coming down.
Yeah, my view is that it probably will be a replay to some extent that happened in the global financial crisis, which was far worse, right? The values resetting were far worse, far more dramatic and faster. But a lot of lenders said, we've learned from the previous downturn, the nuclear winter of the early 90s, where a lot of lenders said, gee whiz, we've got a distressed book where, and all these properties we don't know what to do with, we'll just disgorge them onto the market at fire sale prices. And, that was a big mistake. It was great for some, many real estate investors who had confidence in the future, would love to buy at 10, 20 cents on the dollar, and they did. A lot of REITs started in that environment. A lot of investors, Starwood, Sam Zell, really made a lot of money during that time. When you're buying at that rate, at those kind of prices. But I think lenders learned from that. They said if you just, hold on, you blend and extend,
Mhm.
you work with your borrowers, and the losses are on paper. They're not realized yet. So keep it going and play the longer game. The longer game is values will probably come up. Cap rates are beginning to compress. The economy will eventually improve. NOI will bail you out, and rent increases will bail you out probably over time, right? Real estate is a very good hedge for inflation, both in the base rent and the escalators. It's always been so. So even if there's, 2% inflation, you have that going forward. That's pretty, kind of long-term rate, 2%. And in certain sectors, you can be higher than that, right? Like multifamily, higher demand, logistics, industrials had higher than that. We are going to be higher than that in the medical sector. Um, and I think you don't realize that distress if you're a lender. So you just keep it going, you blend and extend. I think that's, yeah.
Mm.
And I think returns are going to suffer, right? So those debt holders are going to have a higher rate, but an extended term. They don't have to, sell their properties. It won't be forced on them by and large by lenders. Lenders don't want that either, right? They don't want to realize those losses. They don't want to replay of, what they saw or their fathers their ancestors saw in the early 90s, where a lot of banks went out of business, a lot of money was lost. And the most recent lesson, which is the global financial crisis, they were much more patient, and everybody was expecting dramatic distress and properties everywhere at bargain prices, 10, 20 cents on the dollar, something like that, 30 cents on the dollar. It didn't happen by and large. It really didn't happen. And I think the same will be true today. I think lenders will be patient, prudent. Will take a longer view,
Mm.
and if you look at some indicators like the stock market, which usually pretends a better economy, but it's looking ahead typically a year and a half, if you recall. So I think a lot of companies, a lot of investors have confidence in our economy longer term, and you're seeing that in the stock market. So I think that is kind of, I think a lot of investors borrow, those who borrow that debt at very low rates will take it on the chin in terms of their returns, and they'll probably have to put more equity. Longer terms, higher rates, less return. But I think you won't see a great amount of distress, even though it's a big number. But bear in mind, the market is, never you can never step in the same river twice, as Anaximander once said. We're a much bigger pie than we were in the global financial crisis, for example, much bigger than we were in the early 90s. So it's a big number in absolute terms, but relative, it's, to those crises, it's actually smaller. And I think lenders will be more accommodative. I really do.
Yeah, and they certainly seem to be as well today, right? I mean, but and it's slightly separately, but in terms of current policies, you've talked about tariffs and inflation pressures probably only having minimal long-term impact on commercial real estate. What gives you that confidence, David? I mean, it's not unusual. I'm just interested in how you think it's likely to.
I just like to be different. No.
Just because he said that, I'm going to say this. No.
I think it's there's safety in numbers to say, oh my God, tariffs are coming, the British are coming, it'll be terrible. The sky's falling, right?
Right.
But I don't see a lot of analysis, so I just did the
Mm,
arithmetic. I just broke it down. I haven't seen that anywhere. I read it in one of my papers.
mm,
That was published actually somewhere in the Councils of Real Estate journal. And if you do the math, it shouldn't be that big of an impact. Again, our economy is large. Imports are a fraction of that, 11% of GDP. You
mm,
break that down. I think a lot of exporters, export oriented economies like China, South Korea, Japan, Germany, for example, are going to be flexible. They want to retain that market share. Exports mean so much more to them than for us. We export a lot, but it's not such a huge part of our economy, right? But for them, they'd rather lower their prices, even though tariffs are hitting them hard, but they want to try to retain that market share. So they did that. China did that, for example, the last time that tariffs were increased under the former Trump administration. You didn't see prices go up very much. You didn't see inflation go up, but there were uh, a lot of doomsayers that said, "Oh my God, it'll be highly inflationary," and they didn't do the math again. So
mm,
just doing the arithmetic, and I think it will be an impact, but it'll be pretty minor, on our economy. And as I said before, the Fed doesn't include total inflation. Their definition of core inflation is, I don't know, it's not quite realistic. It's not what the household
mm,
consumes. The household consumes mainly housing, food, energy, and transportation. And so those are primarily domestic, right? So if you buy domestic, you won't have an impact. There won't be an impact on higher prices on inflation. So and I think everyone's fully recovered from COVID. There's some really big supply chain disruptions, right? That's totally gone. The whole supply chains become much more efficient with technology, with AI. That's dramatic. I mean. I went to a presentation last night about a company. It's called doing the Internet of Things. Really, that's automating, making more efficient the entire supply chain. So I can remember, when you order something through Amazon, it would take whatever, a few days, a week, and I thought that was a miracle. Today, there are many things I'm just shocked within a day. Like I
yeah.
didn't
So
need it
what
by,
time is it?
I didn't need it by five
Right.
o'clock, but it's there because it's efficient, right? It's very efficient.
Right.
And
Mm,
and so those kinds of things are reducing the friction of our economy, which is cost.
mm,
And then if you have AI automating so many things that used to be done by people,
mm,
that's deflationary. So I'm pretty confident if you do the math and look at imports as a percentage of our economy, as a percentage of what households spend, um, I don't think it'll be that great of an impact. In fact, another thing to look at is how technology has made things a lot cheaper, particularly in the technology sector. You know, if you can remember personal computers, a laptop, 20 years ago was a good one, $3,000 to $4,000.
mm,
Every 2, 3 years you got to spend, that much money.
mhm,
Today they're a third of that price, and they're radically
mm,
better. A good laptop could be $600 to $1,000, an Apple or any good brand name. Printers used to be very expensive, $1,000. Now they're like, $50, $100. So things like that have gotten less expensive. They've
mm,
also gotten radically better, more features. The feature set has expanded dramatically, and that's deflationary as well. So
mm,
efficiency, technology has made things a lot less expensive. And technology is a big part of, our economy. Yeah, some of that's imported, but some of it is not. So yeah, that's. I mean, I have a paper if anybody's interested. I think on my LinkedIn website, so you can take a look at that and tell me where I'm wrong. But I've not been really a Pollyanna. I think I try to be realistic over the years, but try to look at break it down into the real components of it and just do the math. And a lot of people just don't do the math and they go for buzzwords and scare tactics and whatever. Um,
mm,
but um, but a little bit of a smaller lesson was, what happened in the previous Trump administration.
mm,
Just no inflation impact whatsoever. And those tariffs have stayed in place over the years. But ultimately, I do think that if you try to equalize tariffs among nations, that will result eventually. It's like game theory. It takes quite a few iterations of the game, because there'll be a response and then another response, and then eventually there'll be an equilibrium there. And and I think it'll be like, okay, we're equal on tariffs, so that will be probably deflationary, and no one has a reason to increase tariffs, because the other party in game theory will respond, right? So everybody will keep tariffs, roughly pretty much at the same level. That will probably result in more trade, more free trade, which is where we want to get to. So there's some pain initially on both sides. But I think we're in a pretty good place because again, you go back to what do households spend? We're a service economy. That's another important point. That's in the paper. 70% of our economy is services. Those are not imported. Those are not imported, right? And what most households spend are domestic goods, right? Even construction of housing, like when you look at housing, oh my God, no concrete, wood, most of those materials are domestic. So that won't even be a very big impact. I think you'll see it a bit on automobiles, but a lot of them are shifting to domestic production. We have, resurgence of domestic production in Tesla. That's mainly domestic. And then I think you'll have a lot of people who are really dependent upon a lot of companies and countries who really need that export. So they're going to reduce the price of their cars. You're seeing it already. And then technology to the fore. I mean, electric cars are looking to be a lot cheaper than ICE cars, than internal combustion engines. You look at China; they're producing electric cars for $10,000, $12,000.
Yeah.
Right?
BYD, it's incredible, isn't it?
So
This,
maybe you don't need all that stuff, in a traditional internal combustion engine. And in fact, it can be cheaper with these kind of economies of scale. So maybe automobiles will be just cheaper anyway, right?
David, what a fascinating perspective and a very interesting economic case for it. I'm gonna have to give some more thoughts to this. It's really interesting. I can't believe actually how fast our conversation has gone already. So
That's fine.
let me see. So let's wrap up. So what I want to do is ask you, let's see, yeah, a couple of questions just to wrap up with. Actually, three questions, if you don't mind. So kind of more rapid fire kind of thing. So for deals today, for new deals today, what underwriting discipline is more critical? Leverage, amounts of debt, hold period, or sector selection? And you can perm any one of those three or however you want to do it. Leverage, hold period, or sector selection today.
Um, yes to all three.
Right,
So
I know exactly.
I think certain sectors are more challenging. Let's face it. I think office is very challenging at a very high vacancy. I think it's around 30% nationwide, so very challenging. And the whole, you got to look at the fundamental need of office. It's not as great as mission critical as it was before. A lot of hybrid workers these days. A lot of people have come back, but still, a lot of people working at home. So you got to look at that, and the strength of the other sectors. Multifamily, will continue to be a very good demand. Medical, certainly, logistics. So, and then retail, you got to pick your spot, right? I think experiential retail, some retail is doing very well, and some is not. The traditional mall, regional malls, not probably doesn't have much of a future. Um,
Mm,
so I think that's always going to be important. What sector and the timing of that sector, the whole period. I would say probably not go out for too long of a hold period because the cost of debt could come down. So you don't want to lock yourself into a very long period of high debt. So I think that's important. I would be more on the kind of 5-year mark instead of the 8 or 10 or longer debt
mm,
period. And in terms of leverage, I think I don't see massive cap rate decompression, right? Which would be, cause
mm,
that equity to be in danger. So I'm an advocate of, prudent, and efficient leverage. So somewhere in the range of kind of 50 to 70%, I think is prudent. And then you have a 30% equity cushion, right? And I just don't believe, I'm not a huge believer of another major decompression, another bout of huge inflation. And then another factor, I think if we continue to be a little bit more prudent on how we spend money, and the current administration seems to be thinking that way, we're not radically increasing government and government spending. It doesn't seem like that, except maybe for defense. That is hugely inflationary. And then the supply of money. right?
Hmm.
We don't seem to be increasing that in the way we did under COVID, dramatic expansion of and money supply typically is the root cause of inflation. So those are factors that would encourage me to say debt is okay. And be a little bit more flexible, do floating rates and probably a shorter term.
Okay, let me ask you this last question then. So, what signals are you watching that, yeah, what economic signals are you watching that are directing or informing your investment decisions at the moment? What are you keeping an eye on?
Well, the Fed, like everybody else, right? Inflation, employment figures, what the government does in terms of policy, new policies, are pretty dramatic, right? That we haven't seen these kind of big changes, these kind of big policies in a long, long time. And so it seems like on a weekly basis a new thing comes out. So I'd look at the investment level of this country. I look at, certainly the growth of household incomes, and I would look at the effects of AI in many, many sectors, right? That's going to be huge. And I think energy is another big, huge part of our economy. It drives a lot of things, a lot of prices, and that seems to be going in the right direction. Um, yeah, and I think investor sentiment is really important as well. I mean, there's a good deal of psychology in investor behavior. And, the stock market has been going wild for the past 8 months, new highs, new highs. So I think you're having a lot of retail investors come in and now a lot of institutional investors beginning to come back into the pond, right? Feeling more comfortable again with potential that recent rate cut mean an inflection point and then cap rates stabilizing and coming down. So I think a lot of capital will come back into the market. And Yeah, I mean, I think good old demographics too, like demographic structure of our economy, of our society is very, very important with an aging population. People tend to be more conservative. They don't spend as much, right? They tend to be, savers, more, hoarding. So those are, I guess, some of the factors, and this just how we, trade policy going forward, right? If it's going to continue to be adversarial, or if countries will say in that game theory kind of approach that they'll fight a little bit, and there'll be this new Nash equilibrium. Like, okay, we'll charge the same tariffs, and we won't be adversarial. So that'll be more predictable, more predictability in the supply chain, going forward. But I think a lot of companies are pledging to invest in the U.S. And that'll be very positive. Very large amounts. So maybe it has that effect of encouraging more manufacturing here, more investment here in this country, and that would be very good for the U.S.
David James Lynn, PhD from one of the best universities in the world. I have to say that. School of Economics. Thank you very much.
My
And
pleasure.
Chief Executive Officer of Unity Investment Management. Thank you so very much for joining me on the show today.
Adam, it was all my pleasure. Thank you for having me. Appreciate it.
All right, that was David Lynn, PhD, Chief Executive Officer, Unity Investment Management. What an enormous pleasure, David. What an enormous pleasure having met you actually in the first place and having had the opportunity to talk to you in such depth as we did today. Thank you sincerely for having joined me. And thank you too, dear listeners and dear viewers. As I mentioned at the beginning of this podcast, if we're not connected on LinkedIn, go ahead, look me up, Gower Crowd or Adam Gower. You should find it fairly quickly. Connect with me and join the conversation. We have some interesting chats and some very interesting people, very well educated, bright people there on LinkedIn, enjoying some conversations about some of the most important factors and matters affecting the world of commercial real estate today, all there on LinkedIn. Okay, that's it for today's episode. Thanks for having joined me, everybody. And until next time, this is Adam Gower signing off.